So let me introduce our speaker and let her get started. Our speaker today is Dr. Linda Wang. She's the National Timber Tax Specialist with the USDA Forest Service, and she's going to present to us today on income tax on timber for your 2013 return filing. Linda?
Thank you so much to you, Bob, and also to Dr. Eric Taylor from Texas AgriLife Extension, Bill Hubbard from Southern Region Extension Forestry. Thank you all so much for helping with today's webinar. And thanks everyone for tuning in. This is Linda Wang. I'm National Timber Tax Specialist from U.S. Forest Service. We are the federal agency in forestry. My background, I'm an author on federal income tax and estate tax on timberland. I have a CPA certificate and a PhD in forest economics. Tax is very, very important for private woodland owners. In fact, tax is consistently listed as one of the top concerns for private woodland owners. This is because tax is one of the large expenses for owning and managing property. Today in this webinar, I'm going to go through A to Z on timber tax issues. Hopefully you get a pretty good idea on how to take tax deductions and learn the special tax incentives for timber income, saving your taxes. At the end, I'll answer your questions. One of the first things that we need to really know is the, let's go back to the slide here, is the woodland classification for tax purpose. All right, okay, I'm sorry, probably my audio connection had a little glitch here. I want to go back to this slide of here. Alrighty, so the reason that we wanted to learn about the three woodland types is that tax rules are different for each property. And now we have three types: personal property. Let me get the, okay, here is, where is it? All right, that's okay. Investment property and business property. So let's look at what is personal property. Of course, everything you own is personal property for you, but for tax purpose, the personal property is defined differently. It has its own special meaning. Personal property is when you own your property mainly for personal enjoyment, such as personal hunting, fishing, family retreat, rather than for making a profit. So the difference here is that you can enjoy the personal trips, all of that, but your primary purpose is not for making a profit. The disadvantage of owning your property for personal property is that deductions are very limited. Now, let's look at the second type of woodland classification for tax purpose is investment property. Investment property is when you own your property primarily for making a profit. Now, you don't realize income from your timber property every year, and that's okay. The main issue is to document you have profit motive. Even if you don't realize the income every year, that's because timber is never an annual crop anyway. But as long as you have profit motive, one of the best way to document the profit motive is in part of your woodland stewardship plan or forest management plan, you can have a paragraph that address your objective for owning property. And you can say, I own my property to produce commercial timber. So the key word is commercial here. And you can include some cash projection and your harvest rotation time, even if you don't have current income, but you have that objective to produce commercial timber. The advantage of owning the property for investment property is that now you can look at tax deductions. Now, if you own your property as a business property, that's when you regularly and continuously engage in the activity primarily for making a profit. The difference between investment and business property is not very clearly defined by the tax law or rules. It depends on individual situation. However, in general, the activity you put in your investment property typically does not rise to the level of a business. So after we learned about the 3 types of classification, and we can look at how woodland expenses are taken for each type of property. And we're talking about here the cost of tools, fees for forestry consultant. You may have fire break maintenance cost. You may have stand management expense, insect disease control cost. You may have vehicle or overnight travel cost. All of these expenses, let's see how they are treated for tax purpose. We're going to look at deducting this expense by woodland investor first. Ordinary and necessary woodland expenses are deductible. So they are deductible when you incur these expenses. However, there is a restriction or a disadvantage here when you own your property as an investment property. And that rule is that the expenses is subject to a 2% of your adjusted gross income reduction. So yes, they are deductible, but if your income is too high, such expense is reduced or could be eliminated in that year. Let's look at example. Okay, let's say your woodland expense was $1,000 for 2013. Because your adjusted gross income, which is AGI, if it's $40,000, only $200 is the final deduction amount, and that's, you take that on Schedule A. So the calculation here is that $1,000 is your expense. They are deductible, but not all of them are deductible, because after you subtract 2% times 40,000 of your AGI, and that's $800, and 1,000 minus that $800, your final deduction, you really benefited only a $200 deduction on your tax return. What about business? Let's say you think that you probably qualify to your timber activity as a business. How do you deduct expenses by a business? Well, we need to look at whether you materially participate in your timber growing activity. If you are a material participant, ordinary and necessary business expenses are fully deductible. So they're not subject to restrictions here and there, but you do need to go through the hurdle of material participation. So what is material participation? Well, there are 5 tests. These tests are clear guidelines, which is fortunate. As long as you meet one of the tests, you are considered a material participant. The first test here, it says you are considered materially participating in your business if your participation in the activity is more than 500 hours during the year. So 500 hours divided by 8 hours a day, that's about 63, 64 days during the year, and that's about 2 months, a few days. If you meet this test, you are considered materially participating in your business. If that one doesn't work, the second test is if your participation is substantially all of the participation, then you are considered materially participating. The third test, if you meet this test, you are also okay. Your participation is more than 100 hours, and no other individual participated more than you. So 100 hours divided by 8, you're looking about 12 to 13 days during the year. The fourth test is if you participated more than 500 hours for timber business and other business all combined together. You have to participate in timber or, for example, your farming business, each more than 100 hours in order for this test to apply for you. But this is better because you add both timber and farming together for more than 500 hours. If you meet this test, then you are considered material participant. So what happens if you do not materially participate in the business activity? Then you are a passive participant. What happens to a passive participant is that loss deduction from a passive activity is limited. A loss is when your expense exceeds your income, which is quite typical for woodland owners because they don't have annual income. So if you have a loss from a passive activity when you're running a business, that loss is denied for the current year until later when you have income from this activity. So it's very important to make an annual determination on your woodland ownership type, whether it's personal, investment, or business. It's important to document your hours of participation, including today's webinar, and that's part of your learning the business or the investment to grow your timber for profit. To learn, this is part of that learning. So I recommend you keep a journal, keep all of the silvicultural practice that you have done in your land, work with the forester. So in tax time, then it's easier if we ever get an audit. Oh, I guess we didn't go over the fifth test here, but the fifth test is that you are considered materially participating if you materially participated for at least 5 of the last 10 years. This is a historical test. If you qualify this way, then you are considered a material participation. Okay. Here's a quiz already. And get your computer mouse ready to make your selection. See, this is true or false. The quiz is, if your woodland is investment property, the expenses are deductible, but are subject to 2% of your adjusted gross income reduction. It is true or false. Now you can make your selection. Okay. Well, the majority of us saying yes, this is true. Yes, it is true. The answer is correct. If you own the property as investment property, it is deductible. The expense is deductible. But what most people didn't realize is that they thought, okay, that's deductible expense, is that they did not know that it's actually subject to a 2% AGI reduction. If your income is really high, it could actually eliminate that deduction for that year. All right, let's look at very important topics, timber sales. Just how many emails we got here, tax time confused, is one landowner have a timber sale. So I summarize a typical question is, I have let a company cut down my trees on my land, and I want to know first how to report the $10,000 I received for taxes and what deductions I can take. So pretty much this summarized when you have a timber sale, how do you report that income? Is there any deduction that you can take? Summarize the typical tax questions that we have. So let's look at how we're going to look at this issue here. And we're going to first look at the type of income. The very first question is your timber sale income a capital gain or ordinary income? Capital gains is long-term capital gains is better than ordinary income because of the lower tax rate. For the most people, the maximum tax rate for capital gains is only 15%. High income taxpayer is 20%. But for ordinary income, the highest tax rate is 39.6%. All right. So let's see if your timber sale income qualifies as capital gain. It's very fortunate that for the last 60 years, Congress has provided tax incentive to timber sale. If you have a timber sale of investment timber, in that case, outright sale of standing timber, which also called stumpage and forestry term, held as an investment is a capital gain. So that means that if a landowner is owning their land for investment purpose, which I suspect millions of people owning their timberland for timber sale eventually, so that put them in the category of the investment type. Even though a landowner may not realize that they always thought that's my personal property, but for tax definition, it's good that we are in the investment timber type. If you have a timber sale on the stump, not when you cut it already, on the stump, then that sale as an investment is a capital gain. Right. If you own a timber growing business, sale of timber held in the business have a different requirement here. We got two types of sale. One is a sale of standing timber, same thing as that investment type, that's held in a business, is a capital gain if it's held for more than 1 year. So if it's held for less than a year in your business, it's not capital gain. It's not eligible for capital gain. The second type of sale is most landowner, probably the small woodland owner, do not have this type of sale. It's a little bit more complicated. But what it says is that if you sell cut timber, then all the gains are ordinary income unless a special election is in effect, and the timber must be held for more than 1 year before it is cut. This type of situation is, rather than sell your timber on the stump, that you have someone cut it, deliver to the mill, or just cut it, and then they're not paying you just for the standing timber. They're also paying for the cut part, if including transportation to the mill part, that part, and you turn around and pay the buyer the cut and haul part. So it's different than just a sale on the standing timber, and that's a little bit more involved. So for most landowner, if they just did an outright standing timber sale, it's relatively easier for tax reporting purpose. They are capital gain in the business if it's held for more than 1 year. Now, the second question when you have a timber sale is, when you determine it qualified for capital gain, there are two types of capital gains. Only long-term capital gain is taxed at a lower rate. The short-term capital gain is taxed at the ordinary tax rate. Is taxed at ordinary tax rate. Short-term capital gain can be used to offset short-term capital loss, but if you have a net short-term capital gain at the end, it is taxed at the ordinary income tax rate, so it didn't get the capital gain benefit in terms of tax rate. How do we qualify for long-term capital gain? Long-term capital gain is defined when you own your property, your timber, in this case, for more than 1 year before sale. That's long-term capital gain. Short-term capital gains are when you own your property 1 year or less before you sell it. There is a good news for inherited property. Inherited property is automatically considered long-term. When we look at timber sales, the third questions that we want to look at is the deductions from the sale. If you understand this formula here, then you get a good picture about what you can take from the sale as far as deduction. You have your gross sale proceeds, that's the payment you get from the buyer. Instead of taxing on that sale proceeds, you get to take deduction on the basis. Generally, that basis is the cost. There are other bases. We're going to define that. Generally, it's the cost. So when you think about basis, think about when you sell your house. That's the if you purchase the house, for the most part, people purchase their house, then that's the cost that you paid for the house. And that's the basis in tax term. They give it the term basis because there are situations when you inherited the property or someone gave it to you, then that's not the cost. And so they put a term basis, will define those for you. But so here is the cost of your timber. You can minus that, and then minus sale expenses. If you hired a forester, if you hired an attorney looking at the contract, any other expenses, tools, you can deduct that from the sale, and then you're taxed only on the taxable gain. So let's look at what is basis. For purchased property, your timber basis is the cost you paid for the property. Now, remember, only the cost you paid for the timber portion, that is separate from that of the land. the basis for the timber and land must be separate according to their relative share of fair market value. So here is an example of a correctly established timber basis. As you look at this, the first line, pine pulpwood product. This landowner have 200 cords, and it's valued at $2,000. And then you look at down here, pine saw timber. You realize the timber basis is really different from other assets in that the bases have 3 types of product here, not just one product. They have 3 in this case. Pine saw timber, they have 10 MBF is 1,000 board feet. That's a unit to measure saw timber. And you can also, in the South, they use tons for all of these different products. That's the value is 3,000. Hardwood pulpwood, same thing here. You add the value together, that's $6,500. As you can see, the basis, or people call it account, basis account, timber basis, does not just have one type of product. It also has volume here and value. Not only just the value, 6,500, it has the volume here. This is a correctly established timber basis. Now, if you are running out of time for the volume part, you had timber sale, you got the value part. If you sold all of your timber, you don't need to allocate between the different type of product. You could take that as your basis, but you can try to do the estimation by the volume after you finish your tax return. Because if you sold all of your timber, then your value is the one number that you take off the timber sale. But a correctly established timber base does include both value and volume. Okay. Now, there is a special situation for inherited property. The basis for the inherited property is the fair market value of the timber on the date of the decedent death. So we got a question here, is fair market value of the timber back on the date of the decedent death. If you inherited the property 15 years ago, then the market value of timber 15 years ago, that would be the basis for your inherited property. It's not today's fair market value. How do you establish basis for inherited property if you haven't done so 15 years ago? You could do it retroactively. So you could estimate using projection backward of the timber growth back to 15 years ago. If you can do it yourself, that's all good for you. If you don't want to work with a consulting forester, that's like a CPA in the tax profession. They are the professionals in forestry, and they can estimate backward the volume and come up with the value. When you estimate the value, you need a price. The price, there are a lot of university publications. You can take a look at that as a starting point, because there are many factors goes into value, how much your timber is worth, and local factors, the distance to the mill, your logging conditions, all of that, the quality of the trees, the different type of product, they work differently. So it is kind of complicated to correctly determine the timber value 15 years ago. So we recommend you work with a forester, and that's not something that your CPA does, because they're not in the business of forestry. To find a consulting forester, we definitely recommend talk to the county extension, state forestry agency, or natural resource conservation. Their agency, their office, they have typically keep a list of consulting forester, or you join a landowner association to find those foresters. There are people who try to estimate, use a growth factor, 5% of growth every year. So they're going to try to use that and do a backward estimation of your timber value then. I would say that we need to know the volume. For the correct way to do that, then really we need to know the volume and the value back then. The problem, for example, with a percent, 5%, whatever, 3% estimation, is that if 15 years ago this tree is not a saw timber, it jumped product category. It was a pulpwood, and it's much less valuable. It may be even pre-commercial, pre-merchantable timber at that time. That formula may not work, even though you can derive mathematically a value backward, but it may not be right. So there's a caution over there. Yeah, I think we addressed this question, is that if I inherited the timber property 15 years ago, does this mean I have to go back 15 years to estimate the fair market value of my timber to set up my timber basis? Yes, the answer is yes. Now, there is a point here, is that if the tree was very young, or there wasn't much timber on it when you inherit your property, or when you inherit your property long times ago, so it may not be worthwhile to establish that basis, because the basis may be a low number. You may not benefit much from your tax return on that deduction. It may not be worthwhile for you to go back and hire people and estimate that. So how do you, once you establish your basis, how do you recover that basis? Well, here's a term. It's called depletion. So it looks complicated, but it's really not really all that. If we look at this slide here, we will figure out what is depletion means. So I'll give you an example here. The first line here, $9,000 total basis of your saw timber. So I assume you have established your basis for your saw timber total basis. The value part is 9,000. What about the volume part? And you have 300,000 board feet. That's the total volume of your saw timber. On all of your tracts, and you add them together, that's your total volume. So 9,000 divided by 300 give you $30,000 per 1,000 board feet. I mean $30 per 1,000 board feet. So that is called your depletion unit. Total basis divided by your total volume give you a depletion unit. Let's say you sold only 1/3 of your saw timber this year in 2013. So that means you sold 100,000 board feet. 30 times 100,000 board feet, that's the volume sold, and that gives you 3,000. And that 3,000 is your depletion deduction from the sale. So as you can see, if you haven't sold all of your timber, saw timber, that 300,000 board feet, you can't take that 9,000, that total basis, off of your timber sale. You get to deduct 3,000. That deduction is called a depletion deduction from the sale. So, all right. Now we figured how we can recover basis from the timber sale. And let's move on to another important topic for woodland owners, reforestation cost. After you did your timber sale, your forester may recommend you to reforest. Or you bought a property, you want to plant trees to your property, and that's called afforestation. That also applies here too. It's applicable here. That's also what we're talking about here. Whether you plant trees or reforest a harvested property, it's here there's a special tax incentive for that. We're talking about hired labor, your seedling cost, site preparation cost, your equipment, computation control to establish the trees. Those type of costs are reforestation costs we're talking about here. So the cost deduction is in 2013, you can deduct outright the first $10,000 per year of qualifying expense per property. $10,000 per year per property. That's for merit filing joint. For single taxpayer or merit filing separate return, you get to deduct $5,000 per year per property. And then in addition to that, you can take in what's called an amortization deduction. It'll take a little bit, we'll go through an example on this. You take another little deduction on any additional amount over the $10,000 over 84 months. 84 months is 7 years. And let's look at example here. Let's say the total cost of your reforestation project cost $14,000. This is over the $10,000. So you're going to have an amortization in the second step. The first step is take $10,000 assuming merit filing joint. Take that deduction. And that extra $4,000 in the first year, you take that $4,000 divided by 14. And that's because we have accounting what's called a half-year convention. So the 84 months is a 7-year recover period, but because the accounting convention, so it's a half year in the first year. Instead of divided by 7, you divide it by 14. So you're going to take additional $286 in the first year of reforestation plus the $10,000 deduction. And then in the second year through the 7th year, you take divided by 7, and then you're going to take a $571 deduction. And then in the last year, year 8, you take the last $286 deduction. All right, let's look at what is Form T. It's called Forestry Activity Schedule. This tax form has 5 parts. First part is acquisition. You fill out when you inherited a property, purchased property. It's a relatively simple part of the form. Second part is called timber depletion. So we go over how you calculate timber depletion. And this part is more involved a lot of forestry terms. So it's good to get a forester's help. Or you can read up some of the forestry publication, learn it yourself. The third part is called profit loss from land and timber sale. So if you have a sale, this part is the third schedule. Reforestation and timber stand activity, any stand activity is the fourth part. And ownership is when you change your ownership, which just means if you sold your timber or sold your land. When you sold your land, you changed ownership. That's part of the form you fill out. Now, who must file Form T? The instruction to Form T lists 3 conditions. In those 3 conditions, people are required to file. But most people, most small woodland owner probably not falling in those three categories. So here is what we said when we work with Internal Revenue Service agent. They said that it's prudent to file when you claim depletion deduction, and if you're in the business taxpayer, whether or not you are required to file or not. So what this means is that when you claim a depletion deduction, it's prudent to file. There is a situation that if you're occasional timber sellers, then you're not required to file. The occasional timber seller are defined as 1 or 2 sales every 3 or 4 years. I guess that's why I'm saying that most landowners don't conduct timber sales 1 or 2 sales every 3 or 4 years. They may have a sale in many years. So in that situation, the instruction says they are occasional timber sellers. They're not required to file. However, the first point here is that whether you're not required to file or not, even if you're not required to file, it's prudent to file when you claim depletion deduction, or if you're a business taxpayer, because if you're running a business, you need to learn the Form T of different parts, and that's part of doing business. If you're a material participant, you get a full deduction on your expense, but you do need to go through additional learning and record keeping here to show that you are in that business. Alrighty. Here is the second quiz. Get your computer mouse ready. Make your selection here, true or false. Form T, Forestry Activity Schedule, is a tax form. Is this true or is this not true? False. Alrighty. Yeah, most people are correct, and I say it's a tax form. It is a tax form. It's designed by the Internal Revenue Service, but it's called an informational tax return. Also, that's another name. Most people not required. I mean, small woodland owners, large companies, they are required. But the Form T is a tax form. Even though you may not be required to file, it's a good form you can use to keep track of your record. If you look at that and you prepared a Form T at audit time, it really helps, and you're probably ahead of the game even with some of the professionals who do not deal with this tax form at all. So it is an information tax return. People may not be required to file with their tax return, but it's a very good way to organize your timber transactions. Great. Okay. Another very frequently asked question is on some of the payment landowner received. In our forestry profession, we call it cost share payment. Those are the checks that a landowner receives from agency, forestry, an RCS, or Farm Bureau, any of those agencies that serve you to help you with your planting, for example, your thinning of your trees, or insect disease controls, to help you with that, to cost share your silviculture activity. And so that's why we call it cost share payment. How do we treat this for tax purpose? Are you paying tax on that? Is that income to you? Cost share payment must be included in your income unless it qualifies for income exclusion. Exclusion here is a good one. If it's excluded from your income, you're not taxed on it. And that's under tax code section 126. So here's an important tip to know is that the excludable cost share payment must be from an approved forestry or natural resource farm program. It must be used for capital project rather than a expense type of project. So a capital project such as a reforestation. The approved program, for example, CRP, Conservation Reserved Program, Conservation Security Program, those programs, some of the state programs also qualifies. So when you receive a check, you might need to go back to the agency, ask what kind of program this cost share money come from. That's important to know because some of the programs are not approved for Section 126 status. And the second tips is that if you spend the cost share money not on a capital expenditure, then Section 126 benefit also do not apply. So in reality, few taxpayers benefit from this section. This section is not very well written. The regulations are not defined very clearly how to calculate the exclusion. But if you do qualify under these two tips here, look at our publication to see an example how you calculate the exclusion. So for the most part, if you included the cost share payment in your income, now if you spend it, you can take a deduction on that. So that's not too bad on that because you may take a deduction when you are a investment or business property. All right, timber loss from casualty. We have a lot of questions on the casualty loss. That's the type of loss when you didn't have a sale, you have forest fire, you have some hurricane damage, and those events. Casualty means you have unexpected, sudden, unusual event occur to the land. So you have timber loss from those events. For tax purposes, those are called casualty loss. Can you take any deductions from the casualty? Well, you can. It turns out casualty loss, yes, is deductible. However, well, here's the detail part that may not be all that good news, is that the amount of deduction is the smaller of fair market value loss of the timber or the timber's basis. Fair market value loss or the timber's basis. Now we can see that the basis is important. What if you didn't establish the basis or your basis is zero and now the timber is gone and or it's damaged and you need to if your basis is zero, then your amount of deduction is zero. So we don't have deduction, and that's why it's important to establish your basis. It may take time. As long as you start the project to establish it, it may take months or in some cases years. They put everything together, find the right person and to do it. That's fine, and as long as you do it quick enough before we have a casualty, before I have a timber sale, that all helps. So it's not that if you haven't established, you have to establish before this tax deadline. So for future planning, you can start to think about establish your basis. And here's an important point here is that timber basis and fair market value loss is for the entire timber account versus only destroyed portion. So for our CPAs here, normally if you have a casualty loss, for example, if a casualty only damaged a third of the property, the basis that you use to calculate the loss is for the entire tract, not just for the destroyed portion. That potentially give you a larger deduction. And that's a special case for timber. Quiz. All right. Ready? Is cost share payment income? I want you to make your selection. Is it A, yes, you must always include it in your income. B, no, it's not taxable. C, yes, but certain qualified cost share may be excluded from your income. We're waiting for publishing our results. And I can see most people choose C. You can show the result here. 62% show C, which is the correct answer. I guess when I'm saying that in the most part, few taxpayers benefit from this exclusion, it's not because some of the cost share don't qualify. Just in reality, few taxpayers may benefit, but there are qualified programs that's used for capital projects that does qualify. It's probably very few people is able to do that. But yes, there are certain qualified cost share payment can be excluded from your income. Nowadays, I got so many questions on the new program that haven't been approved for the, for example, the conservation stewardship program is not approved yet. They haven't gone through that approval process. So if you receive payment from that program, then yes, it's income for you. But you remember you can take a deduction on that. Another quiz here. And this is reporting timber sale and claiming casualty loss may involve timber basis. Is this true or false? I accept everybody get it correct. Thank you so very much. Yes. Yes, it's true. That's true. I am so glad about this because we learned the basis is not all that intimidating. If we just be a little bit patient enough and see how it works. Thank you so much. All right. Here is an important question on 1099 form. So this is when you sow timber. When anybody, in general, if you pay someone for the goods or service, for example, you hire a contractor to do something for you, you pay them over $600 or more, you're supposed to issue a 1099 in general. Now, when you sell timber, the form is called 1099-F. And so there are a lot of questions, particularly from our consulting foresters, who wanted to make sure that they comply with the tax law, is that who must file this 1099. So you could have a forester here, you could have a logger here involved, or a mill, the company who, the saw timber mill who bought your timber eventually. So between all these parties and the landowner, the seller, who are responsible for issuing a 1099. Here is instruction on 1099-S. The 1099-S, the language is written for sale of real estate, and timber is considered a real estate before sale, before they were cut. So here is the language. The instruction says, the first one, it's on this order. The first person who are responsible is the person, including attorney or title company, responsible for closing the transactions. Attorney or title company responsible for closing the transactions. So in our timber situation, if you've got attorney responsible for closing the transactions, we rarely probably don't use title company. So that would be the first. If we don't have any of that, then the second one is called the mortgage lender. So if there's a mortgage involved, the mortgage lender, I'm sure they'll take care of the reporting. The seller's broker or the buyer's broker. So the language, as you can see, the broker, seller's broker, and really they're talking about selling your house. So I don't know how that applies to our timber situation. So the last one is the buyer. If we don't have any of those first four, then the buyer is responsible for issuing 1099. It's important because if the 1099 is not issued, there are penalties, and it's very important. That's because if you issue 1099, then the Internal Revenue Service have computer to match that income if people forgot to report that income, because the 1099 already issued to the Internal Revenue Service telling them that this person received a timber sale payment for this much. So that's why it's important to do that. All right. This is a brand new tax. 2013 is the first year for this new tax, but it's only for high income taxpayer, and for the most people probably it doesn't apply. But it's important to know that beginning in 2013, investment income of a high income taxpayer is subject to a new tax of 3.8%. Investment income, and that means it includes capital gains from timber sale. This is a brand new tax. We didn't have this before this 2013. So let's say who is affected. The tax applies to taxpayers with adjusted gross income of $200,000 for single taxpayer and $250,000 for couples only. So if our adjusted gross income is not $250,000 for couples, now this tax does not apply. You do not pay this tax. I'm just going to show you an example. Let's assume your adjusted gross income is $260,000. Let's say your salary is $200,000 and $60,000 timber sale, which is capital gains, and you're a single taxpayer. The way this 3.8% tax works is that it's not on the entire adjusted gross income. It actually on just the excess amount over the $200,000 threshold for single taxpayer. So $260,000 minus $200,000 times 3.8%, and that's a little over $2,000 tax that this taxpayer need to pay in 2013. Didn't have this tax before, and this is part of the healthcare reform. This is a new tax law in that package. We also have sweeping changes from the Fiscal Cliff Bill that's enacted on January 2nd, 2013. The main part that affect timber owners, there are this long-term capital gain maximum tax rate. Now we have two types. It does get a little bit more complicated, and 20% maximum rate if your income is over $450,000, a different threshold joint return, or $400,000 for single taxpayer. Your maximum tax rate is only 15% for the rest of the taxpayers if your income is not over the threshold. And that's a very significant change on the tax rate for long-term capital gains. There's another significant change from that fiscal cliff package is the ordinary income tax rate. Now the maximum tax rate 39.6%. Long-term capital gains rate, if you summarize all together, you have a 0%, 15%, 20%, 23.8% for types. So although I put a mark here is that the 3.8% is tax on the excess amount over this threshold. And that 0% is if for married couple you make a little bit more than $70,000 and there are capital gains from timber, for example, and that capital gain portion is taxed at 0%. If your income is over that a little over that $70,000, then your maximum tax rate is 15%. So we have gone over all of the topics for today, and this publication was out last year. It has examples on each of the topic, and if you have any additional questions, it's on the website. You can just search the keyword here. There are a lot of sites that carry this publication. It's easy to read, so I definitely recommend you to take a look at that. I think now we are ready to take some questions. I guess you can type in your question in the chat window, and we will address each question. I think Bob is going to read the question, and then I'll try to answer the questions here.
So as Linda indicated, if you have any questions, please type them into the chat window.
Do we have any questions yet?
Actually, we have 8 so far, Linda. So our first question is on states, because of the 2% of AGI deduction, it seems like it would be best to bunch timber operating expenses.
I guess I can't hear Bob. Let's see.
It looks like your connection speed slowed way down for some reason, Linda. So just hold on a second, and we'll.
I need to turn off my microphone too.
Yeah, I don't think she can hear you.
I don't think so either. So bear with us a second, folks, and we'll get Linda's audio back.
I'm sorry, I don't. Okay. Oh, I think. Okay. See, yes. Bob, are you there?
Yes, I am, Linda. But I don't think you can hear us for some reason.
I don't think I can hear you.
So,
I can hear you now.
okay, good. So the first question is, because of the 2% of AGI deductions, it seems like it would be best to bunch timber operating expenses.
Yeah. I guess when you said you wanted to put all the expense together, actually you're right. Connection speed. Can you hear me? Okay,
we
Bob?
can hear you fine, Linda. If you just want to keep going.
Okay, let me see. Okay, let's see. Audio setup cannot be wrong. Oh, okay. Let's see. Alrighty, I'm ready.
Okay, Linda, can you hear me?
I can hear you now.
Okay.
Okay. I hear your questions, the bunch the expenses together. Exactly. So actually, your forest.
We cannot hear you, Linda.
Absolutely. That's a very good question, is that actually the timber management expenses is part of what's called a miscellaneous itemized deduction that's subject to that 2%. So in tax law, you have all types of expense. You have what's called a miscellaneous itemized deduction that's subject to that 2%. Some of them don't. Alrighty, thank you. Now, if you have any other type of miscellaneous itemized deduction, you can also bunch them together with forest management expense. Exactly. And then you, yes, I can. Yeah. And so when you put them together, then have a larger number, yeah, that's better. I think as a practical matter, you could choose.
Okay, bear with us, folks. She's going through audio setup. Hopefully this will clear up the issue.
Alrighty, can you hear me now? I'm so sorry.
No, that's okay, Linda. Yes, we can hear you fine.
Okay. So the question on the bunching, put together, combine all the forestry expense, it's good. It's actually part of what's called a miscellaneous itemized deduction subject to 2%. If you look at Schedule A, you should also bunch that together with all other type of miscellaneous itemized deduction subject to 2%. For example, what are some other miscellaneous? If you paid a tax preparer to prepare your return, you paid $100. That $100 bunched together with your timber management expense, and that's also subject to 2% of your AGI reduction. And they should encourage people to, get a deduction to work with a professional. But I guess that's what the tax law says. So, in practical sense, some of the expenses you could carry it in your book, which means you don't take that current deduction subject to that 2%. What you do is that you just simply elect to put that expense into the timber basis, increase your basis. And of course you have to wait until you have a timber sale to take that deduction. Now, if your income is really, really high and you can't take that current deduction anyway, so in that situation, you could elect to put that expense into part of your timber basis.
Okay.
All right.
So next question is, what is meant by no other individual participated more in material participant test? Who is other individual?
Oh, alrighty. Thank you. Yeah, let's say, for example, something quick to come up with, you work with the forester. Well, I think a lot of time forester really take care of a lot of things for us. So any other people other than you that have perform work on the property, if you participated more than any other people, you hire somebody to do things and you participate more than that individual, then that means that you are materially participating than that. That also requires you to document the hours each person has performed work on your land.
Okay. So next question. If the timber is in a trust that goes to descendants upon death, does that still make it inherited property? The decedents do not have access to the trust until after the owner's death.
Okay, I think I have to look up exactly on that, but my interpretation is that, yeah, if it's lived in a special trust, of course, the what happens in the trust is a fiduciary. They need to file a informational tax return called a fiduciary tax return. If they have income and expense, the trust itself need to have a 1041 tax return filed. But what happens is that when they do the trust tax return, the same rule applies. They do have that for inherited property, the fair market value appreciation for the basis, and then once they establish all that, they will allocate that to each individual, the beneficiary. So they will get that. Each one will report on their own tax return. That's how generally it works from a trust to that individual. I definitely recommend you to work with a professional when there's a trust involved. Here is the reason, because according to the trust term, one has to read what the trust says, and different tax rules applies in a lot of situations, even if it looks like it's the same. Depending on the term of the trust, things change. So in general, yes, the fair market value of timber on the date of decision, that rule applies to the trust too.
Okay, the next question is, in the following example, can you tell us whether the sale is capital gain or ordinary income?
Okay.
The example is, the timber is business property. It is sold to the mills based on a contract price, and it is cut and hauled by a third party that is paid by the timber owner. If it is ordinary, when is the election made to treat as capital gain, and is there a different computation?
Based on what you have said, it seems like it falls under that second type of timber sale. You're not merely sell timber on the stump. You're actually paying someone, cut it, and sell it to the mill. Did the mill give the check to you, and then you turn around and pays the people who cut the tree and delivered it? Here is the general guideline. If you hired people to cut the tree and deliver it to the mill, and all right, I'm back.
Okay, we hear you.
All right, Bob, can you hear me now?
Yes.
Okay, all righty. I'm holding the connection here, still break. Yeah.
I apologize again, folks. Seems like she's having trouble with her connection again.
Yeah, I think your computation, it looks like that's what's called a Section 631A transaction. If you not only just sold timber on the stump, you hire people to cut it, and then the transaction ends when, if you hire people to cut it, they pay you and that's it, and they haul it and cut it and deliver it, and the rest they take care of that. As soon as you hire someone to cut it, and then they deliver it to the mill, and they get the payment from the mill, and then they pay it to you, not only for your standing timber part, you also, let's say the mill pay you a check, and then you turn around and pay the cutting and hauling the people, the loggers. In that situation, you make a special election. The computation is different. you can check that publication that in the last slide. There's a very good example how you calculate. Basically, the parts that appreciate while the tree is still standing, that means that the fair market value minus your basis, that's capital gains. Anything after that, that means that the payment to you from the mill minus the fair market value, that's ordinary income. You got two parts involved. One part is capital, the other is ordinary income. You can send me an email and I can help you in more details about how to calculate that.
Okay, thanks, Linda. Next question. To follow up on the previous question, the contract price with the mill is set prior to the timber cutting. It is key who is responsible for cutting and determining the nature of the gain. So they're wondering if the person that's doing the cutting, are they the key to this determining the nature of that gain?
The difference between just outright sale of standing timber or you cut it and subject to that special election is not who's cutting. It's determined by if you hire this person, cut it, and then as soon as you've done that, and then also transport it to the mill, you got a payment not only just for your standing timber, but also for the cutting and hauling part. You turn around and pay the logger. Then you are directing all these transactions. You're not only selling a standing timber anymore. You're also involved in the cutting and hauling, or maybe not even the hauling part, but in your situation it have a cut and haul part. If you're involved in that part, then what I mean by involved is that you direct them which mill to go to, and then you determine how much they get paid for. You hire them to do the cutting and hauling part, and you keep the part for your timber part. In that kind of situation, that's what's called a cutting contract in the tax term. Then you do have two parts of gain. If you just sold your timber outright to any cutter, they come a company or logger, they cut it and they paid you, they're gone, then yeah, then that's just capital gain straight all the way, and you don't have that special election, that issue to deal with. Okay, thank you. Next question is on reforestation. Is the $10,000 deduction on Schedule A? And then also, where does the amortization schedule and 1040 line number? Thank you so much for that question. Yeah, I didn't have time to go over in that detail, but you are right. Okay, now it's different for business versus investment. Thank you so much, and then we now don't get confused with the tax treatment. Okay, for investment property, that $10,000 actually is so good. It's above the line deduction, so it's not affected by your income level. You take it in the front page of 1040. In the front page of 1040, there is the last section is called adjusted portion, adjustment to your income. For example, if you have tuition for students, if you have moving expense for job, new job, those are called adjustment to your income. So there is not a specific line for reforestation, but from all the regulations and tax code, reforestation at 10,000 is a adjustment to your income. So you couldn't file electronically. You need to file a paper one, write on a line that you don't use and say reforestation. and that's that $10,000 plus the amortization goes to the depreciation schedule. So you have three types of depreciation. Depreciation regular, that's depreciation, and you have depletion, that's we just go over, and then you have amortization. These are all same idea to depreciation. You can't write that expense all in 1 year. You have to divide by a number of years recovery period, get a smaller amount each year, and that's using that depreciation form. I think it's form 40.
All right, so the next question is, would a state timber yield tax required to be paid on a harvest be included in the direct sale expenses in Part 3, number 7I of Form T?
Oh, Bob, I'm sorry for the breakup. And so before you read another question, for business property, the reforestation expense is not taken on Schedule A, not on the front page of 1040. It's on Schedule C, on other income expense line. So for business person, you report your income expense on Schedule C anyway, so that goes there. And then also your computation on the amortization on that Part 4 of depreciation form.
Okay. So the question now is, would a state timber yield tax required to be paid on a harvest be included in the direct sale expenses in Part 3, number 7I of Form T?
Oh, thank you so much. Yeah, Form T, last time it was revised in 2005. Just this last year, December 2013, the Internal Revenue Service issued a revised Form T. As far as I can tell, the instructions have changed. They don't require what's called that unique stand identifier, stand identification number for reforestation and some other changes. So what you said about the severance tax and issue, that's very good. I need to check. I look at the tax form changes. It doesn't seem it has substantial changes, but I will go back and check to see if that's a new change on that line. So thank you for pointing that out. For states that does have the yield and severance tax, those are deductible from your sale expense. That's part of the sales expense that reduce your tax.
Okay. Next up is question 8, and wondering, is the maximum 20% on the income over $450,000 for joint filing, or for the entire capital gain for high income families?
Thank you for that question. Here's how the long-term capital gain works. That 20% is the maximum tax rate. So if you, let's say you have 0 salary, all of them are capital gain, long-term capital gains. For merit filing joint, the first a little bit over $70,000, it's taxed at 0%. Anything over that, maximum, if you are in that $450,000 category, your maximum tax rate is 20% instead of 15%. So, so that's how the capital gain works. It's not you can take advantage of the 0%, but it's only up to that a little bit over 70,000. After that, it's taxed at a maximum rate of 20%. And that's how that works. But if you use the software, it'll automatically calculate based on your income level applied to the maximum rate. Now, if your income is less than $450,000 for merit filing joint, the maximum tax rate after that 0%, then it would be only 15%. So there's that 5% difference. That's how that works.
Okay, Linda, before we go on further with, we have about 8 more questions, but because we're at the end of the hour and a half, I would like to push out the link for people to go ahead and take the survey and things like that. It is going to take a minute or two for the survey and quiz to load on your computer. So bear with it. There's over 100 of us still online here, and the system will be trying to load all 100 of us at one time because of the technology. I'm going to make that available. You can click on it there in the chat window, but before you do that, I'm actually going to push it out using the technology, which will open your browser. And so bear with it as it takes a moment to load. And while it's doing that, we can get back to the questions with Linda. So Linda, we'll move on to the next question while that loads for people. So number 9, when determining a basis, are there a minimum requirement for the cruise, such as 10%, 20%, etc.?
Oh, that's very good, and I don't think there's any requirement on that. What the instruction says, there's a audit technique, and one of them mentioned is that just lay out the process, do a sampling. It didn't require any specific how many percentage. No, it didn't say that. I think a forestry consultant will determine professionally based on, do a competent appraisal. So whatever the situation requires, then that would be it.
Okay. If the property was transferred over to a family member at no cost and the original owner is still alive, what would be the basis amount?
Thank you. I didn't go over the gifted part, and I guess this is the situation. If you transfer property while that donor is still alive, that's not an inherited property. That's not a purchased property. Now, in this situation, is you gift that property to someone. For gifted property, the general rule is the donor's basis transfers to the donee. So whatever the basis in the donor's hand is going to be the basis for the donee. That's in general. Now, just a little bit of a complication. Let's say if the land, for forest land, it should appreciate, and the timber grows. So for appreciated assets, for example, timber, the timber price fluctuates. So if it's appreciated, then the basis transfer to the donee. If the property lose value, then it would be the lower of the basis or the fair market value. But so in general, it would be just the donor's basis. If you want to see an example or the specific language on that, you see that publication at the end. It's spelled out very clearly. Okay.
Next question. They're wondering, can they take the operating expenses as expenses on Form T in the year they sell timber?
All right. So depending on the what kind of operating expense, if the expense is directly related to the sale, always take that from the sale, because that reduces your income, your taxable income. Now, if the expense is just a regular normal operating expense that's not related to a specific sale, you do report as investment on Schedule A, you business on Schedule C. Whether you are required to file Form T, you put that expense on Form T. As I said, it's always good for record keeping. You may not be required to file that Form T. So that Form T is informational return. It's only information. To have an impact on your tax return is whether in Schedule A or Schedule C.
Okay, so the next question has to do with the reforestation deduction. They're wondering, can you provide any information on what a qualified timber property is for the $10,000 reforestation deduction, especially as related to property that may be contiguous but managed as a separate land and timber account?
Thank you. Thank you. That's the question. What they're talking about is that they have contiguous timber tracts, but managed for different timber accounts, and that's a very specific term. So I would, in my interpretation of the tax law, excuse me, the poor property, all right, I'm back. The per qualified property is, I think, is for your specific timber account. So even if you have multiple tracts, because you set it up in the way that you manage in different timber accounts, you can have $10,000 for each timber account. That's my interpretation per year, per property account. What they say is that if you already take, let's say one of the accounts you already take depletion, and you cannot combine that with an account that's already taken depletion. So you wanted to keep the whatever the account you managed originally, you reforested that property, and that's a $10,000 right there.
Okay. As a landowner, how do I count for my hours worked to justify the 100 or 500 hours to the IRS?
Alrighty. What you do, you write a journal. Everybody know how to write journal with a date. January 1st, I attended this webinar for how many hours, what I learned. Then next day, I went to a landowner association meeting for a forestry subject. Another day, for how many hours, I talked to consultant foresters, and they prescribed a forest management plan, woodland stewardship plan. Those are all examples of participation. Another day, I drove there and I checked the, we don't have fence, we check the boundary, the fire breaks, and make sure it's to check things. And you write down how many hours that you, that's how you show how many hours. At the end of the year, you add all the hours together. I think it's not that difficult to meet the hours of participation.
Okay. So can you explain what is a timber depletion deduction?
Alrighty. Timber depletion deduction. That term depletion really is used when you start to cut your timber or you sell your timber, and that's actually a deduction, like you said, just like a depreciation. So if you, let's say you own 100,000 board feet saw timber, and if you cut all of them, you have a basis of when you paid for, let's say you spend $1,000 when you first acquired them, then that $1,000 is your depletion deduction. You just deduct that $1,000 from your sale. However, let's say if you didn't sell all of the saw timber, you sell half of the saw timber, half of the property. Now, you do need to calculate what's called that depletion, is that you just use the total basis on the whole tract and divided by the total volume of your timber, and to get a number per unit of the dollar value per unit of your timber. And you sold half of the timber, so use that unit times the half volume on your land. That's get your depletion deduction. So really, it's a way to recover your cost. Just go back to that slide that we gone over, and you can see the calculation is just a division and a multiplication. So and also there's this publication text guide you can check for examples. It's worked like a depreciation.
Okay. Next is a question related to a logging road with culverts and facilitating a harvest in future years. So the question is, what class of depreciation and the life of that depreciation is used for a logging road with culverts over streams to facilitate a harvest in future years?
Alrighty. I think for temporary road, I need to look up for that. I think it's 15 years. Is it 5 years or 15 years? I have to look up for that. The culverts, well, I guess if you said you build a logging with culvert. Culverts are, I think, 5-year property. Let me look up a 5-year. So the point here is that culverts is separate from the logging road. They are, you need to, for example, if you own computer, it's separate from your furniture. If you use them for investment or business, you take depreciation on that. In this case, we have a temporary logging road. I don't know if you have a temporary or permanent, but if it's permanent, you can't take a depreciation because that's part of the land basis. Temporary logging road, you can depreciate that and then separate that from the culvert. The culvert also is depreciable. As far as how many number of years, either 5, I think it's 15 years for temporary road. The way to look up that is, let's see, I don't have that publication with me now, but you can send me an email, I'll send it to you.
Okay, next up is, do I need to apportion between property and timber the cost of a land survey to determine forest boundary for a timber harvest? And then do I need to depreciate the cost, and if so, what is the class and life of that?
Could you repeat that question?
Okay, so it's a two-part question. We'll start with the first part. Do they need to apportion between the property and the timber the cost of a land survey to determine the forest boundary for a timber harvest?
For a timber harvest. So are they asking that they do a boundary survey for the land and to determine, okay, if the survey is used for the timber sale, because you do need to know where the boundary is, then you deduct that from the timber sale. If the survey is to re-establish the boundary, that's part of the land cost. That's not, you can only recover when you sell the land. So document that purpose correctly. You can or cannot take the deduction. If you do the survey for the purpose of selling timber, that's part of the expense of selling timber. You can take that deduction. What's the second part of the question?
So the second part was, do I need to depreciate that cost, and if so, what is the class and life?
So like I said, if it's part of the land, then we cannot take depreciation. It's part of the cost to facilitate the timber sale. You can just deduct that from the sale.
So it's a straight deduction.
Right.
Okay. So 2 questions left. Hang in there, Linda. So number 17, if you sell timber through a consulting firm, they pay you stumpage. But on the 1099-S, they report the total receipts of the timber sale, including cutting, hauling, and their commission. Can you still report your revenues as capital gains, since that is all the consultant paid you?
Wow. Okay. First, I would go back to whoever issued the 1099 to you. Get a corrected 1099. You were not paid for all the cutting and hauling, all of that, and you were not paid for that. And I wouldn't expect the computer to look for that bigger number. So I would get a corrected Form 1099. That would be the best course, because it might raise audit flag if they issue a 1099 with a $10 payment, where in fact you were only paid $8 for your tree. The other part is not concerned with you. So that would be a kind of problem. Other than that, they could issue a 1099 just showing the parts that apply to you, that only the payment that you receive. Supposedly, they're supposed to do that.
Okay. And then the last question is, I was curious about, in reference to CRP. So when a landowner cuts the CRP trees, do they have to deduct the amount they received up front from the government program?
From the well, if it seems like this landowner received a CRP cost share, in this situation you actually have to report that cost share. You need to determine whether that cost share is income or not. I don't see a deduction. Oh, I see. You use that CRP cost share to did some silviculture treatment. Whatever the amount you spent, for example, the government issued you $5 and you also spend your own money, $5, so you spend a total of $10. So you include that $5 from the agency as income, you get to deduct $10.
Okay. So I don't see any more questions in the chat window. I think you've addressed them all, Linda. Thank you very much.
All righty. Thank you.
Thank you all for staying on. I know we are a little bit over time, but we want to make sure we got through all the questions so everybody had an opportunity to hear that. If you have trouble with filling out the survey, or if you had trouble with the quiz, feel free to email me. I've put my email there in the chat window for you to contact me if you need to. Again, Linda, thank you for your time and energy in doing this. I know it's a long time, almost 2 hours speaking. We do appreciate it, and thank you very much.
Thank you so much.